China, Japan, Germany, and Norway have just offloaded billions in U.S. Treasury holdings. This isn't just a routine adjustment, it's a move that could shake the very foundation of the global financial system. Some are calling it a warning sign of an impending economic crisis, while others believe it's a calculated shift in global power. The question is, who's right? For decades, U.S. Treasury bonds have been considered one of the safest investments in the world. Governments, banks, and institutions stockpile them as a hedge against uncertainty. But when some of the world's largest economies start aggressively selling off their U.S. debt, it raises a serious question. What do they know that the rest of us don't? The U.S. dollar isn't just a currency. It's the backbone of international finance, the primary reserve for most economies, and the benchmark for global trade. If major players begin dumping U.S. treasuries, the consequences could be severe. Rising borrowing costs for the U.S., increased market volatility, and even a shift away from the dollar as the world's dominant currency. Some experts are already warning that this could trigger a global financial meltdown. Others claim that this isn't about economic collapse at all, but rather a strategic realignment of global power. And here's the craziest part. This isn't just about money, it's about control. Because if you look deeper, you'll see that the real reason these countries are selling has nothing to do with simple financial adjustments. So what's really going on? The answer is far more political than economic. But before we get to that, let's break down the official reasons they're giving, and why those explanations might not tell the whole story. On the surface, it seems like a purely economic move. Countries regularly adjust their financial strategies, so why is this different? Why does this particular sell-off feel like a warning sign? Governments and central banks have their official explanations, statements carefully crafted to sound rational, harmless, and controlled. But do those explanations actually hold up? Let's take a closer look at what they're saying, and more importantly, what they're not. China has been gradually reducing its U.S. Treasury holdings for years. Officials claim this is part of a long-term strategy to move away from dollar reliance and strengthen its own currency, the yuan. They argue that being too dependent on the U.S. dollar exposes China to economic vulnerabilities, including potential financial sanctions from Washington. On paper, that explanation makes sense. But here's what's strange. China isn't just slowly reducing its holdings anymore. It's accelerating the process, shedding tens of billions at a time. If this was just about financial stability, why the sudden urgency? This isn't the first time China has signaled its desire to challenge the dollar's dominance, but the scale of its recent sell-off suggests something bigger is at play. Is Beijing preparing for a financial confrontation with the U.S.? Or worse, is it bracing for an unavoidable economic war? Japan has long been one of the largest foreign holders of U.S. treasuries, so why is it suddenly dumping billions of dollars in U.S. debt? The official reason? A weakening yen. With the yen struggling against the dollar, Japan has been offloading U.S. treasuries to prop up its currency. Selling these bonds allows the Japanese government to raise cash and stabilize its exchange rate. It sounds logical, but there's a problem. This isn't a minor adjustment. Japan has been the biggest foreign investor in U.S. debt for years, and now it's pulling back aggressively. The real question isn't just about defending the yen, it's about whether Japan is losing confidence in U.S. economic stability. If Japan, one of America's closest economic allies, is starting to hedge its bets, what does that say about the future of the U.S. financial system? Germany has framed its reduction in U.S. Treasury holdings as a pivot toward green energy investments and a broader European financial strategy. According to German officials, they are reallocating funds towards sustainable investments and reducing dependency on non-EU financial instruments. But here's the part they won't say publicly. Germany has been quietly increasing its gold reserves at the same time. If this was just about green investments, why stockpile gold? An asset historically used as a hedge against financial instability. Could this be a sign that Germany is positioning itself for a future where U.S. influence over global finance is weaker? For decades, the U.S. and Germany have worked closely together on economic policy. But if Germany is now shifting away from the dollar, is this the first real sign that Europe is trying to distance itself from American financial dominance? Norway's sovereign wealth fund is one of the most conservatively managed financial entities in the world. It rarely makes drastic shifts, yet even Norway is cutting its U.S. Treasury holdings. The official explanation? Norway is diversifying into high-yield investments and digital assets. It claims this move is about adapting to a modern financial landscape. But let's be clear, Norway's economy is built on oil wealth. Traditionally, when oil-producing nations reduce U.S. Treasury holdings, it signals concerns about future dollar stability. If a country as financially cautious as Norway is making a shift, what does it see coming? All of these countries have provided seemingly rational reasons for their sell-offs: currency stabilization, investment diversification, risk management. But there's one glaring issue. They're all doing it at the same time. This is not a coincidence. And when multiple economic powerhouses start moving away from the same financial system, it's not just a shift, it's a signal. That's what they're saying publicly. But the real reason for this coordinated sell-off? It has far more to do with power than it does with economics. And that's where things get even more interesting. These sell-offs look like strategic financial adjustments, but when you zoom out, the pattern is unmistakable. This isn't just economics, it's a political maneuver unfolding in real time. And whether or not the US wants to admit it, this could be the beginning of a silent financial war. China has been the most vocal about its intentions, pushing what it calls de-dollarization. The official narrative is simple: reduce dependency on the US dollar to avoid economic blackmail. But behind closed doors, Beijing's real strategy is far more aggressive. By offloading US Treasuries, China is not only safeguarding itself against sanctions, but actively weakening the dollar's grip on global trade. And here's where it gets even more interesting. China isn't just selling US Treasuries. It's simultaneously increasing its gold reserves, forming trade agreements in yuan, and investing in alternative financial structures like the BRICS payment system. This is more than diversification. It's a direct challenge to US financial dominance, one that could reshape the global balance of power. Japan and Germany's moves might seem less confrontational, but they're no less significant. Both nations have historically aligned their financial strategies with the US, relying on the dollar-centric system. But now, they're distancing themselves. Japan is using its treasury sell-off as a currency defense mechanism, but why now? Why take such a drastic step unless they see major instability ahead? Germany, on the other hand, has been subtly pivoting toward a more independent European financial strategy. Its increased focus on gold, alternative reserves, and green investments suggests a long-term plan to reduce reliance on US financial instruments. And with growing tensions between the US and the European Union on trade and defense policies, could Germany be laying the groundwork for a financial separation? And then there's Norway, a country known for its cautious, methodical approach to economic policy. Unlike China or Germany, Norway isn't a direct economic rival to the US. But even it is quietly shifting its assets away from US Treasuries and into high-yield alternatives and digital assets. Norway isn't just protecting its wealth, it's hedging against a potential collapse in the dollar's dominance. This raises a critical question. If even smaller, stable economies are making this shift, what do they see coming that the average investor doesn't? And here's where things take a turn. Because if this was just about smart financial planning, the US government wouldn't be as worried as it is right now. So what's the real concern? The answer might shock you. For decades, the United States has relied on one key advantage: unmatched global demand for its treasury bonds. These bonds are what allow the US government to fund everything from infrastructure to military spending while keeping interest rates relatively low. But now, with China, Japan, Germany, and Norway unloading their holdings, that demand is weakening, and the consequences could be severe. The first and most immediate impact: higher borrowing costs for the US government. If fewer countries are willing to buy treasuries, the US will be forced to raise interest rates to attract investors. This means the cost of servicing America's already massive national debt will skyrocket, putting immense pressure on the federal budget. More money will go toward paying off debt, leaving less for critical programs, and if this trend continues, it could push the US toward an unavoidable financial reckoning. And then there's the dollar itself. A decline in treasury demand means a decline in trust in the US financial system. The result? A weaker dollar. A falling dollar may sound good for exports, but the reality is far more dangerous. The US economy is heavily reliant on imports, especially for energy, electronics, and essential consumer goods. A weaker dollar would mean higher prices across the board, fueling inflation at a time when Americans are already feeling financial strain. But that's just the start. If inflation rises too quickly, the Federal Reserve would be forced to respond with aggressive interest rate hikes, making borrowing more expensive for businesses and consumers. This creates a vicious cycle: slower economic growth, rising unemployment, and an increased risk of recession. And here's where things get even more dangerous. If enough countries start selling their treasuries, it won't just hurt the US economy. It will threaten America's global financial dominance. For years, the US dollar has been the world's reserve currency, giving Washington immense power over global trade and finance. But if major economies continue to shift away from treasuries, that power starts to erode. Countries will begin using alternative currencies for trade, reducing their reliance on the dollar entirely. This could set off a chain reaction where other nations follow suit, further weakening America's ability to influence global markets. In the worst-case scenario, we could see a new financial order emerge, one where the US is no longer the dominant economic superpower. And if you think this sounds bad, wait until you see what happens if China decides to escalate even further. China may have offloaded a significant portion of its US Treasury holdings, but here's the real concern. It still holds over $750 billion in US debt. That's a staggering amount, and if Beijing decides to dump it all at once, the consequences for the US economy would be devastating. This isn't just speculation. Over the years, China has made it clear that it wants to reduce its reliance on the US dollar. It has actively sought to shift global trade away from dollar-based transactions, forming new financial alliances and promoting the yuan as an alternative reserve currency. The big question is, what's stopping China from pulling the trigger completely? Some analysts believe China is holding on to its remaining treasuries as a last resort economic weapon. If tensions between Washington and Beijing escalate, whether over Taiwan, trade disputes, or military posturing, China could decide to weaponize its US debt holdings. This scenario, often referred to as the nuclear option, would involve Beijing unloading its treasuries in bulk, flooding the market and crashing US bond prices. Interest rates would spike, the US dollar would face massive devaluation, and financial markets would be thrown into chaos. Of course, this move wouldn't come without risks for China. A rapid sell-off would likely hurt its own economy in the short term, as the value of its remaining assets would plummet. But here's the key. China is already preparing for this possibility. Beijing has spent the last decade stockpiling gold, diversifying its reserves, and strengthening financial ties with non-Western economies. It has also pushed the yuan as a trade settlement currency, signing deals with Russia, Saudi Arabia, and other nations to move away from the dollar. This means that if China ever decides to go all in, it may already have a financial safety net in place. So, would the US retaliate? Absolutely. Washington could respond with harsh economic sanctions, trade restrictions, or even financial countermeasures to try and contain the fallout. But there's no guarantee these tactics would work. In fact, they could backfire, accelerating the shift away from the dollar and forcing other countries to rethink their reliance on the US financial system. And here's where things get even more concerning. China isn't the only one making moves. Other nations are quietly stepping back from the dollar as well, and one of them in particular might surprise you. For decades, the US dollar has been the undisputed global reserve currency, but the cracks in that dominance are becoming more visible. As countries like China, Japan, Germany, and Norway reduce their US Treasury holdings, another pattern is emerging, a shift toward alternative financial systems. One of the biggest challenges to the dollar's dominance comes from the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries are working on a new global reserve currency, designed to bypass the dollar entirely. The idea is simple: create a trade and financial network that operates outside US influence. This isn't just talk. China and Russia have already begun settling trade in yuan and rubles, cutting the dollar out of their transactions. India is increasingly using rupees for oil purchases, and Saudi Arabia, the world's largest oil exporter, is now open to selling oil in currencies other than the dollar. At the same time, central banks around the world are making one critical move. They're buying gold at record levels. Gold has always been the go-to safe haven asset in times of economic uncertainty. But what's happening now isn't just about hedging against inflation. Countries are actively replacing their US dollar reserves with gold. Why? Because unlike US Treasuries, gold isn't tied to the policies of the Federal Reserve or the decisions of Washington. And then there's the rise of digital currencies. China has already launched its digital yuan, a state-controlled digital currency that could become a serious competitor to the dollar in global trade. Over 130 countries are exploring or developing their own central bank digital currencies, CBDCs, which could eventually reshape international transactions. Cryptocurrencies, once dismissed as speculative assets, are also playing a growing role. Bitcoin, stablecoins, and decentralized finance (DeFi) projects have become alternative stores of value, offering a financial escape from traditional banking systems. While they won't replace the dollar overnight, their increasing adoption signals a move toward financial systems that are not controlled by any single country. And that leads to the real question: are we witnessing the end of the US dollar's global dominance? If enough countries move toward alternative reserves, digital currencies, and gold, the dollar may no longer be the world's default currency. But before we answer that, we need to look at what the US is doing to fight back, because Washington isn't going to let its financial empire collapse without a fight. The US isn't watching this shift away from the dollar unfold without a plan. If anything, Washington is preparing for a full-scale financial counteroffensive. But the question remains, is it enough? The Federal Reserve's first line of defense has been aggressive interest rate hikes to stabilize inflation and attract investors back to U.S. Treasuries. By offering higher returns, the Fed hopes to keep global demand for U.S. debt strong. But this strategy comes with a dangerous side effect. Raising interest rates too much can choke economic growth, trigger recessions, and increase the cost of America's own debt payments. At the same time, the U.S. has another powerful tool in its arsenal: financial sanctions. Washington has a long history of using the global banking system as a weapon, cutting off adversaries from the U.S. dollar-based financial network. Countries like Russia, Iran, and Venezuela have all been hit with sanctions designed to limit their access to the dollar. But here's the risk. The more the U.S. weaponizes its currency, the faster other nations look for alternatives. This is already happening. China, Russia, and even traditional U.S. allies are building systems to bypass American-controlled financial institutions. If sanctions continue to push countries away, the U.S. might be accelerating its own decline. Then there's the final play, the one that isn't talked about openly. The United States doesn't just control the financial system, it backs it up with military alliances and strategic economic deals. The U.S. dollar is deeply tied to global energy markets, with oil-producing nations like Saudi Arabia historically agreeing to sell oil exclusively in dollars. But as we've seen, that arrangement is beginning to fray. To counter this, the U.S. is strengthening its military and economic ties with key allies. Defense agreements, trade deals, and political leverage are all being used to reinforce the dollar's dominance. If a country wants U.S. military protection or access to American technology, maintaining dollar reserves might be the price they have to pay. But here's where it gets even crazier. Some believe the U.S. is setting a financial trap. Instead of being caught off guard by the sell-off, could Washington actually be encouraging certain countries to dump treasuries? If the U.S. knows a shift is inevitable, it might be trying to control the collapse on its own terms. And if that's true, the next phase of this financial war is already being planned. What if everything we've seen so far, the sell-offs, the shifting global reserves, the rise of alternative currencies, is actually playing right into the U.S. government's hands? It sounds counterintuitive, but some financial experts believe the U.S. wants certain countries to dump treasuries. The theory? A well-orchestrated economic trap. Here's how it would work. By letting adversarial nations like China and Russia sell off U.S. debt, Washington allows them to weaken their own dollar-based holdings while the U.S. quietly prepares to buy back treasuries at lower prices. If true, this would be one of the most strategic financial moves in history. The U.S. could effectively reset its debt obligations at a discount, strengthen its grip over the global economy, and reinforce the dollar's role as the dominant currency, all while its competitors think they're gaining leverage. But there's a big risk. What if this plan backfires? If the dollar weakens too much, if the sell-off happens too quickly, or if too many countries shift away at once, the U.S. could lose control of the system it built. The balance is fragile, and one miscalculation could mean the end of the dollar's supremacy. So what's the reality? Is the U.S. maintaining its dominance through hidden economic strategies, or is it slowly losing its grip on global finance for good? The answer to that question could shape the future of the world economy. And that's where you come in. What do you think? Is this all part of a U.S. master plan, or is the dollar facing a real existential threat? Drop your thoughts in the comments. We want to hear from you. If you found this breakdown insightful, make sure to like and subscribe for more deep dives into the biggest financial shifts happening right now. We'll be following this story closely, and trust me, this is just the beginning.